So it's not about Tata versus Birla's. It's just a coincidence that A. Balasubramanian, who represents Aditya Birla's Sun Life AMC, is there. We will not talk about Tata versus Birla. We will not do that.
Thank you.
Let's talk about why this year we managed to outperform the globe so handsomely. The biggest market in the world, which is the S&P or the US market, has seen a market cap erosion of nearly $3.5 to $4 billion.
Correct.
Yet Indian markets are standing tall. Is this only an optical illusion that 15-20 stocks are doing well, but the rest of the market is hollow, beaten down, broken down, and is in pain?
I think it's something to do with the among the emerging market. I think if you look at the global market last year, developed markets were doing initially well, and later part of the year they did very badly, especially US in the last 2 months have done extremely badly. And the same, if you again look at the emerging market, especially post this US-China trade war, and China did extremely badly. I think they are the biggest contributor to the global negative growth when it comes to the question of market cap loss. But India remained somewhat insulated. 80% of the market, which is the top 100 companies, which is drive the Sensex as well as the broad market cap in the country. Out of that, top 10% or top 20% have done exceedingly well. One, the fundamentals of those companies have been getting better, and second is India also have got large proportion of the representation coming from the service industry. Service industry last year did exceedingly well, and some of the companies are benefiting out of the exports thanks to the rupee dollar movement. The earnings also is improved, as you rightly mentioned about TCS. It is the entire software sector did well actually last year. At the same time, fundamentals of the economy did not get deteriorated as much as we have seen in China. The fundamentals of the economy, despite oil price touching as is about 85, and we were almost at a threat that oil will cross 90 and the rupee dollar will go to about 75, and all of them actually were handled quite well. I think given the ability and agility that the government brings on the table as well as the regulator brings on the table, and with all those things, I think we could manage it quite well.
But the best performing index this year actually has been the FMCG index.
Exactly.
That's got nothing to do with the government. That's got nothing to do with what's happening to interest rates. That's got nothing to do with what's happening to the world. It's a pure indication of the fact that fund managers were nervous and they moved into FMCG stocks.
I'll just have a slight disagreement on that, especially in FMCG when they've done well. FMCG has done well for two accounts. One, the reduction in GST did benefit FMCG companies as well as the consumer both. It did benefit both consumer as well as the companies in terms of reducing prices and improve their margins. At the same time, from a consumer point of view, the reduction in prices both came. Second is the rural economy has done exceedingly well this year. Though the broad perceptions we actually form on the basis of two-wheeler sales and car sales and so on and so forth. But if you look at the rural economy, consumption coming from FMCG companies actually again got better. And some of the FMCG companies also actually benefiting out of the aspiration of individuals, aspiration of Indians, where the premium products have seen actually the highest level of growth during the year of 2018. This is all reflection of the consumer sentiment, of course, is changing. And finally, the perceived worry that all of us carry that farm loan waiver is bad. Well, it is bad from the fiscal deficit point of view, but they have been benefiting actually the driving the consumptions at large at the ground level. And finally, the government of India also has increased the MSP prices during the current year. Though one can argue actually how much of it you would have bought at the MSP price and how much you would have bought at the discounted price to the MSP price. Leave aside that argument, but the overall increase in the MSP price itself actually boosts the consumption.
No, that indeed is the case. But between consumption and investment, Bala, what would be your preference in terms of an investment decision into the coming year? Because politics will be center stage, policy making will be core.
Correct.
And you're already looking at consumer names being priced to perfection, priced at a premium. Is there a stronger case then to increase allocation to the investment-led themes?
I think this again is a good observation that I think if you analyze the Indian market as well as the broad Indian economy, the theme that has remained permanent for our country is actually the consumption. Thanks to the high population, thanks to the growing per capita income, and also the aspiration levels of the large pool of middle class population is rising, and the government spending towards making more and more cities as cities more like semi-urban kind of cities. All these things have been leading to an increase in consumption. And therefore, this theme will remain as a permanent theme, whether it is for 2019 or 2020 or 2022, given the fact that the rate at which they can grow continuously, I think is quite significant. Second is post-demonetization, though one would have forgotten that impact of that, what it had in the broad economy. I think post-demonetization, definitely there is one change that has happened from unorganized sectors. Moving towards organized sectors has been quite significant. That I think if you see it, the companies in that space, I can even take the name of the company like Titan, has been the biggest beneficiary of unorganized becoming organized. And that has happened actually in the footwear segment. It has happened in the textile segment. Therefore, this benefit I think will only come in the economy over a period of time. Also, this benefit companies that operate in that space over a period of time. So, therefore, from money managers' point of view, valuation will remain as a concern, but one also cannot ignore the power of companies that can provide over a period of last 1 or 2 years, over a period of say 5 to 7 years.
But Bala, we saw a similar phenomenon in 2007 when world discovered the word subprime crisis. I think that happened in July, August 2007. Then India started outperforming. Everyone thought that this is that famous decoupling, that what is happening in the world is not affecting India, Indian markets outperformed. But after 8-9 months, the subprime problem became bigger. And then you had a Barron's turns followed by Lehman and then the big financial crisis. Okay. My only fear is that whatever is happening in the US market, whether it is crude or erosion in FANG stocks or higher interest rates, the telltale signs of a bigger economic disaster are coming. And when that is going to haunt us, we will fall like 9 pins because we are a liquid market, we are dependent on global flows, and when we will fall very fast.
Of course, yes, that's a fear we always carry, and as we progress and moving more towards developing developed economy, definitely the synergy between India and rest of the global market is very, very high. There is absolutely no doubt on that. Money at the end of the day is fungible. But having said that, if there is a recession or there is actually a fall actually in the US market, as we rightly mentioned earlier, the FANG stocks have been a single largest driver of US economy and taking the market caps into multiples of $1 trillion that has come out of the FANG stocks. And if you see actually the fall actually coming in the FANG stock, logically speaking, that should not affect India and that should not affect emerging market as well. That's one. And secondly, there is a negativism that gets set in the global market, and actually the money has to move from one market to the other market. Last year we have seen money moving out of the emerging market to the developed market, especially in the US. We will probably actually shift I think happening towards in the Indian market. As long as the economy does well and does not get caught such as the US trade war between India and US and China, and as long as we don't get caught in that kind of scenario, and whatever effort that I have been putting in the last few years in making the Indian economy self-fulfilling from the point of view of driving the domestic growth, and if also backed with a good monsoon this year, backed by the another big factor which is the stability in the political environment, I think India probably will get decoupled in the year 2019 or 2020 as a result of these developments. That's the hope I think all of us have to have.
Bala, so with that presumption, start of 2018 pretty much one took that tactical call that it's safest to be staying put in large caps, reduce your exposure to small and mid caps, and I guess one only got conviction as the year rolled in, given the kind of stark underperformance and correction that we've seen in small and mid caps. 2019, with not much of the macro parameters changing and still got very important cues and data points that the market would react to, would you still as a fund house recommend that a larger allocation be made to large caps, or do you think now, value-wise, you find small and mid caps a little more attractive than large caps?
Of course, while the argument is right that in general when there are uncertainties, large cap does better than the small cap. I think 2018 is the worst year for mid cap and small cap companies. The fall has been quite severe, and though the earnings are not deteriorated as much as what has happened in the case of the earnings, but definitely stock price has been quite hit badly. Having seen that kind of fall, I think the one single largest factor which is driving the macroeconomic variables more positively is around the oil price, the related impact on the inflation as well as the interest rates. If these two factors sets into right direction, with the government focus on bringing in a higher focus on SMEs and MSME lending through the RBI norms getting changed. I think the larger proportion of the mid and small cap market would begin to outperform the 2019. So therefore, from the asset allocation point of view, while one need to have some bit of allocation towards the large cap, and given the fact it has less volatility and a better standard deviation and so on and so forth, but given the fact that earnings growth can also be literally higher than large cap companies in the mid and small cap space, allocation should go towards the multi cap to mid cap companies in the year 2018. Again, one has to look at not just 1 year. We have to look at beyond 1 year, given the fact that post elections we will probably see the much more positivities coming back to the India, and therefore we'll probably have to look at beyond 2019.
Fair point. So with that assumption, would you say that there would also be that sectoral churn which would get aggravated? Maybe the outperformers of 2018 take a backseat, the likes of IT, FMCG, and we could see the emergence of newer dark horses, newer sectors which have been laggard up until now, and could they overtake the outperformers of 2018?
Yes, it's quite possible. The industries which is largely depend on the input cost, where they have got reduced, especially obviously it comes in the consumptions. There is absolutely no doubt on that. The large pool of service sector industry which is growing, and one of the largest sectors in India is the automobile sectors. There is a reasonably good expectation getting built on the replacement market. The replacement sales have been pretty good in the automobile sector. We probably see some bit of positivism coming back to the even auto ancillary as a sectors. I think if you look at, I think it's going to be more stock specific in picking up stocks in the mid and small cap rather than going by any specific sector. Ultimately, of course, everything will get added to the specific sectors, but from the money manager's point of view, will remain more stock specific focus rather than going to single sectors and then look at actually the top down in terms of stock picking.
Bala, are we in this kind of a market where it is going to be triumph of individual mid-cap stock pickers in 2019? Because a lot of good businesses suddenly available 25-30% cheap. We can talk about a Shankara Buildcon, which is owned by Akash Prakash, or we may talk about Cholamandal, which is owned by Mahesh and his funds and your schemes. Is that the trade what we should look out for, that 2018, if you bought the Nifty, you've managed to outperform the market hands down. It's been a tough, brutal and a cruel year for fund managers, because when Nifty does so well, it's hard to outperform. But will fund managing, a classic fund managing, stock picking, will that make a comeback in a big way in 2019?
I'm not very sure about big way. I think whatever the struggle that money managers had in the year 2018, in beating, as rightly mentioned, beating the benchmark, 5 stocks were driving the Sensex movement, and people are extremely underweight on those stocks for some obvious reasons. Some are, of course, for their own individual reasons. But that, I think, probably that will get reversed. As we are seeing in the last 1 or 2 months, the mid and small cap companies, even the next Nifty 50, which is other than the Nifty companies, has not started outperforming. I think as time progresses, money managers, on the basis of their own individual ability, they are known for stock picking and they are known for creating alpha. I think if the broad market comes back because of the macro variable getting changed, I think the ability of the money manager to pick stocks and given outperformance through the 19 and 20, I think it will take about 1 to 1.5 years for them to come back on a clear alpha generation basis, given the fact that last year underperformance was quite significant to the Sensex and Nifty by most of the money managers.
Will debt schemes give 10% from here in 12 months, or that's very, very difficult because bond yields are what crushed?
Correct.
They will not go back to 6%. So the return could be late single digit, 8%, 8.5%.
I think somewhere around 7.5 to 8% is quite possible in the fixed income schemes, given the fact that your 10-year bond yields have rallied. I think that biggest the sector which has done extremely well is the 10-year bond yields have fallen by almost about 80 basis points from a high of about 8.15 or 8.2 to as low about 7.38 today. And in the fixed income market is roughly about 7.3. And the fixed income market in general, but for this credit crisis that we saw, I think now is coming back in terms of radar from the investors' point of view. Therefore, what we keep saying actually, while mutual fund is considered as investing in equity, one should also equally give importance for investing in fixed income, And given the fact that the power of compounding at about 7.5 to 8% over a period of say 5 years, it's quite high, and therefore that segment cannot be ignored from the point of view of investing in 2019 in the mutual fund, choosing various segment of the opportunities, and fixed income should also figure as part of the investment opportunities.
Right. Bala, let's talk about that, because this whole interaction is about Sahi SIP, right? And invariably through all the education initiatives that we've taken in collaboration with Aditya Birla Mutual Fund as well as ET now, the focus has been where to start the right SIP, kahan shuru karna hai Sahi SIP. And this has been a common question among investors at large. I think a big theme that came out this year, in extension of what you've just said, is balance funds. And you've advocated that, you've spoken about it. It's not about a particular fund house, so that's a caveat, but across the board. As a product category within mutual funds, what's the outlook for balance funds?
So, well, of course, balance fund is definitely reduce the risk of having a higher exposure to equity, at the same time higher exposure to debt, as well as the interest rate fluctuation that happen because of the movement on interest rate movement, as well as the credit losses. I think there's a combination of all the three. Definitely the balance fund does take out the risk that exists actually in some of these funds individually. Having said that, I think there are, as it is, if you look at the large pool of the advisors do have their own asset allocation strategy, where how much the money should go towards the equity, how much money should go towards fixed income, and within that how much the money should go towards large cap and mid cap and multi cap and so on and so forth. The same way in the fixed income as well, people do have an asset allocation strategy towards short-term funds and versus duration funds, etc. I think if one is able to apply that formula and allocating actually the money to the various asset classes, even they will be able to actually manage it better, given the fact that today the taxation structure is, whether you put in equity is taxable, if you put in debt is taxable.
Yeah.
So given the fact these two are common, there is absolutely no reason to believe that only balance is the only fund way to invest. One can even invest the same money through an asset allocation strategy.
Okay. Bala, we leave it at that. Thanks very much for joining us today, and here's wishing you and your team happy holidays, happy 2019.
Yeah, thank you. I also take the opportunity to wish all the viewers across the country a great year ahead, 2019, and wish you all happy New Year.
Okay, thank you once again for being here with us in our studios.